I want to talk about is that warm summer housing market call. And then, of course, how to trade it and what it means. CPI came in. So this morning, the drama potentially around CPI, although I said I don't think it's going to be anything. Last CPI report was a big something because it dropped into a negative figure for the first time since like May of 2020. Anyway, the point was that was very market moving because it was very disinflationary. Yields did in fact crash down, not up, is because of mortgage rates. And I just had this article up for you and I said, hey, also back in that time frame, if you remember, late spring and then again in May, I talked about how I believed yields would fall, that would pull 30-year down, fixed mortgage rates would fall, and that would trigger a refinancing wave, which would make it very beneficial for stocks in that space, which would include, for example, Rocket. So Rocket, and it took a while. This was like, I was a little early with this. And then May, what if yields crashed down? And then, okay, so here it is. So it's worked, but it's been slow. Anyway, Rocket's still going higher and mortgage refinancing has now surged. 35% in 1 week sounds a lot, but I want to show you the actual physical data that I also pulled this morning.
This short clip is presented by Club. Club provides access to Samantha LaDuc and her team of professional macro and micro traders, analysts, and educators. Club is ideal for active traders, investors, and institutions who want Samantha's best-of-breed market timing calls across all asset classes and time frames like chase, swing, and trend. Get the trade before it happens. Sign up Club now and get full access to daily live trading room with Samantha LaDuc, Slack trading desk with detailed analysis and trades, custom trade support when you need it, and much more. For more information, visit www.LaDucTrading.com/club.
So you got CPI disinflating. You've got this yields crashing down, absolutely worked. And here's the data this morning. You can see where MBA mortgage applications, previous 6.9 and then actual 16.8%. It's a big move. What you can't really see is that mortgage rates themselves have really, the 30-year fixed have really come back down. Anyway, the point is, this is the 30-year fixed. And you know that I have just put a head and shoulders on this puppy. So the 30-year fixed got up into this almost 8% area, 7.98. It was really high. And the mortgage rate lock crowd went into hyper mode. Inventory fell off, affordability fell off, rents obviously were quite high. And folks aren't moving and they don't really need to sell unless they're moving. And there really isn't an incentive to sell if they have to refinance at 7-8% mortgage rates. So the housing market is a mobility trade and it stopped moving. Now that's, by the way, that's a fact. You can see when rates are low that there's a lot of moving activity in the stocks that support them. Literally, I can show you papers on this. and when rates spike, when mortgage rates spike higher, mobility slows to a crawl. So those stocks also are hit that support the moving and the housing industry. Long story short, refinancing is in the house. So this is now a head and shoulders that I have annotated, and you can laugh all you want. But one of the ways that I do this kind of in advance call March and then May, what if yields crash down, is because I can see the rate of change in those instruments waning. And that's very important to me. It means it's going to give up its momentum. It's tough to time. We need triggers, but it's going to work. So that's why I put together my intermarket analysis every single week. I review it, and then I pick the highest probability cross asset rotations that I see forming, and then I share them with you. And I've been sharing with you a lot of charts of yields falling and expecting to fall. And I've also recently said, be careful because I see oil is next. So anyway, this is head and shoulders, and it says the 30-year fixed, long story short, has broken below this kind of 6.5 area, and it looks headed to 6 easily. But if this is a true head and shoulders, we're going to have a measured move down to 4. So what would cause mortgages to fall all the way back down to 4%? You got to kind of think about that. Even though we don't have a huge refi wave, this is very important, like a bottom of 2020, 2008 great financial crisis, right, when mortgage yields went right back down to 0, etc. So I'm not talking about that type of spike, But there's no question I am looking at reasons they would finance, more so to meet the inflation that has eroded a lot of their capital and or to get access to this equity in their house. And it will be very beneficial for the Rockets and the Coop of the world, but it will not be beneficial to banks. So banks are making a lot of money at these higher yields. They will start losing that net interest margin, will start to roll over and fall. And the hedging that is occurring in the mortgage space, also the currency carry trade space, is based on bonds that are mortgage bonds that are supporting housing. This is absolutely, by the way, a precursor to a lot of bank weakness. And if we have bank weakness, and by the way, I think this can continue into 2025. So I'm not saying this year. I definitely think we're going to head down to 6%. We could even come all the way back down to this kind of 5.5% bounce. And then next year, but this is what I am literally spotting. And I know the higher for longer arguments, lots of good ones. And oh my goodness, there's going to be a whole bunch of pushback if the Fed, for reasons that I can see that the Fed don't cut in September. I think it'll be a huge trigger for shorting, by the way. But I think they will cut. So I'm definitely still in that camp that they're going to cut 50 basis points. And if they don't, we're going to have a big sell-off and it's going to force them to cut. So forced selling equals forced cutting. I still firmly believe that. I just wanted to kind of go over that again. CPI is absolutely in a disinflationary mode. So is Fed liquidity. We definitely have mortgage rates spiking lower and this mortgage refinancing spiking higher, and mortgage rates, I believe, will continue to fall with yields.
Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.